The views and opinions expressed in this podcast do not necessarily reflect the views or positions of ACUMA, its board of directors, its management staff, or its members. The podcast discussion presented is conversational in nature and for general information only.
Hello and welcome to ACUMA's ONpoint Podcast, the policy series, where we focus on policy issues impacting the credit union mortgage industry. I'm your host, Peter Benjamin. Before we get to our episode, just a quick word from our sponsor.
This episode is being brought to you by Loan Vision. Is your credit union looking to turn your accounting department into a profit driver? Loan Vision can help. Our platform delivers real-time data, loan-level insights, and automations to streamline workflows and improve control over financial performance. Transform your cost centers into revenue generators by equipping your team with the tools needed to better serve your members. And don't miss our monthly webinar series, where we share key strategies and best practices to help credit unions optimize their mortgage operations. Register today at www.loanvision.com under our upcoming events page.
Joining us today as our resident expert is Zach Pfister, Policy Director with Brownstein. Zach, my friend, how are you doing today?
Doing great, Peter.
Awesome. Just leaving it there. Just doing great. Living the dream. I want to say another word, but all the stuff happening in DC just has you just living the dream, fun, exciting times. Man, tell me what is going on in DC that our credit union members need to know about, please.
Well, it's been a wild summer. Congress is fresh off of passing the One Big Beautiful Bill Act. The OBBA, or as some might call it, the OB3. I've heard some refer to it as O3B, but let's just call it the reconciliation bill.
By the way, I am excited to be able to write off my private jet.
Well, you're welcome. Congress was hard at work on that. So, look, there was a lot of political capital that went into pushing that bill across the finish line. It is essentially the bulk of the president's agenda, all wrapped into one piece of legislation. As a reminder for folks listening, in the occasional scenario in which Congress is controlled by one party, and it's the same party that's controlling the White House, they have a tool at their disposal known as budget reconciliation. It is a process in which Congress can enact significant and comprehensive legislation, but also at the same time circumvent certain parliamentary and procedural requirements that traditionally adhere to other legislation. So instead of needing 60 votes to pass legislation in the Senate simply needs a simple majority. And Republicans currently control 53 seats in the Senate, and therefore they had some wiggle room. So Republicans have a cushion in the Senate, 53 seats. Ultimately, they could lose 3 seats with the vice president serving as a tiebreaker. The bill passed in the wee hours of the night, followed by House passage just before 4th of July. So the president got his July 4th bill signing and all the trappings that came with that. And now, I would say that there's been it served as somewhat of a pressure relief valve here. There was a lot of focus and a lot of time spent on that bill. And now Congress is kind of shifting to more traditional items on the agenda that they still need to deal with, but they have kind of put on hold for the last 7 months. And so as we're looking into these last couple of weeks going into the congressional recess, the August recess, there's been a pivot to appropriations bills. The only problem is that the appropriations process has been a bit discombobulated and on ice for the last several months because of the reconciliation bill. So everything is a little bit farther behind as compared to where it would typically be this time of year. We will probably be lucky to see Congress or the House pass one or two appropriations bills next week at best. This is basically going to put them into September and the September 30th government funding deadline with very little to show for it. We are very likely to come into September and veer straight towards that deadline with no progress made, no bipartisan cooperation, and it's going to create another cliff. It's likely going to result in another CR that carries into December, at which point there's a growing consensus that probably means 1 year continuing resolution, straight funding through the election. Because we are also, when we come back from August recess, we will also be in unofficial campaign season for the midterms, even though they are still 16 months away.
So, I mean, there was a lot, in the OBBA, whatever you want to call it. Some controversial, some questionable, depending on which side of the aisle you're on or where your tax bracket is. But there for us as credit union mortgage lenders, some things that are favorable, right? Like our tax status is preserved as part of this. Now that was kind of a surprise that was even in question as part of this, right?
To me, I don't know if I was surprised. The reality of the situation is that whenever you're going to start with a bill that is, $4 to $6 trillion in size, they start with a menu and everything's on the table. It's up to industry and stakeholders to get off that menu as quick as possible. And there are a few organizations and industries better equipped to do that through their grassroots, through their credit union members than credit unions and all the respective trades that were involved in that success. I think that there was an inflection point earlier in the year when the credit union tax status showed up on a Ways and Means Committee draft menu of potential pay-fors, and credit unions were already long activated on this. So it happened to also coincide right around some significant fly-ins and generally fly-in season for credit unions. So I would argue that on the side of the House, it was probably poorly timed for that draft to start circulating in those meetings, even if informational, to be taking place while thousands of credit union members were literally in town meeting with their members of Congress. I don't know that the status was ever truly in the top tier of threats, but that's only because of how strong the credit union movement has been on this issue for years. It is at the core of in terms of foundational elements of credit unions and what they stand for, and that message resonated consistently across the board with Democrats and Republicans. You saw bipartisan members put their names down in writing, which is a hard thing to do, especially if you're in the majority and and you share the party with the White House and they're trying to move an agenda, and you're putting your name down as a red line on certain provisions. Now, we saw that elsewhere, but we definitely saw that on the credit union tax status, and I think it made a huge difference. Coming out of the reconciliation bill, the Senate version also maintained the tax status. In addition, there were, to your point, other cuts and developments along the way that also impact credit unions, probably from a more positive lens in terms of the CFPB. I don't want to say that this is necessarily a plus or a minus. That's for every stakeholder to decide. But the CFPB funding was significantly reduced. They started at
like half, right?
Well, yeah, it bounced around a bit. So the House bill reduced it from a 12% draw to a 5% draw. This is the amount of the Fed's operating budget that the CFPB can use for its own funding. So it went from 12% to 5%, so a little over 50%. The Senate bill then zeroed it out, and the parliamentarian who quickly became the most popular unelected government official in D.C. over the summer ruled that out of order and in violation of what's known as the Byrd Rule. It's basically the rule that helps the parliamentarian decide whether or not a provision complies with the budget reconciliation process. Now, that's a little weedy, but long and short of it is the Senate Banking Committee went too far, in her opinion. So they had to go back to the drawing board, and they came up with a 6.5% draw. So roughly a 45 or 48% cut, just over 50%, right? And that wasn't coincidence, right? And that was after consultation with the parliamentarian. So now the CFPB's funding has been reduced in law by 50%. Let's just say that. Now, that's a lot different from being eliminated. The real crux of what that means in the future is when this administration changes hands, and if it changes to a Democratic administration who's naturally more inclined and supportive of the CFPB, they're going to continue to have their hands tied on that funding draw for the foreseeable future, basically until Democrats at some point in time may find themselves with their own trifecta, because that's the only likely scenario in which that funding can be restored. What I would say looking forward is, if you look at there's a hearing this week in House Financial Services, heavy focus on the committee's continued efforts to roll back CFPB rules, roll back CFPB authorities. There's a whole host of bills that have been noticed for this week that kind of give you the sense of direction where the House wants to continue to move with the CFPB. I would say that this funding cut is not the last time you're going to see Congress attempt to pare down the CFPB's reach.
And so, kind of sticking with, this, well, I say CFPB, but let's also stick with mortgage. The one big, beautiful bill also made permanent, the amount that someone can write off for their, interest write-off, as well as made permanent or brought back the mortgage insurance write-off, right?
Right.
And so kind of walk us through that if you could.
Well, I mean, I would just leave it at the goal of the tax writers in this legislation was to ensure that as many provisions of TCJA 1, right, the original Tax Cut and Jobs Act, were solidified for perpetuity, and so they use the term permanent. Whereas there are other provisions in this bill that that have an expiration date again, and so I can't recall off the top of my head, but there's an expiration date for the SALT deduction. There are expiration dates that create new inflection points in the future, most of which, not by coincidence, will be after the president's term concludes, after his second term concludes. But it sets up future battles for tax policy. Now, some of the key provisions, some of the core provisions, the individual rates, for example, right, that they were successful in cementing these, but there are going to be inflection points in the future. And I should say, back to my earlier point, in the event that Democrats at some point in the future have the House and the Senate and a Democratic president, we should absolutely expect them to use the same budget authorities and take up a partisan reconciliation bill that almost certainly touches on tax policy, right? Democrats, this is a one-party affair, budget reconciliation. It's never bipartisan. So there wasn't a single Democratic vote for this. There wasn't a single Republican vote when Democrats did reconciliation. So we should expect that even things that are permanent are only permanent so long as there's not another party with a trifecta that may want to make changes in the future.
Mm-hmm. So it's all very interesting. I mean, it's interesting. I'm kind of just at a loss for words, right? I mean, but okay, so we talked about OBBA, the one big, beautiful bill. What else is happening in DC? What isn't happening in DC?
Yeah, it's a little bit of both. So I mentioned it, we are now entering into the Q3, Q4 period, which it's interesting because we just got off of a nonstop 6-month, chaos train in terms of, hours spent, members in town working on this big piece of legislation. And now we are on, we are over the hill in some respects where we are going to see a bit of a lull heading into the traditional August recess. But that doesn't mean whenever they get back on the other side of this, in mid Q3 and at the end of Q4, they're not going to have the same problems that they left whenever they left at the end of July. So government funding will be the next big inflection point. Government funding runs out on September 30th. We've seen this show before. We're getting very accustomed to how this works in September. They will have 3 weeks when they get back to cut a deal to keep the government open. We should expect that Democrats have no reason to come to the table on anything. Last time, they weren't even invited to the table. And you saw the continuing resolution in the spring result in full, Democratic opposition in the House, minus 1 or 2 votes. And when it got to the Senate, there was some criticism in terms of how Senate Democrats handled it because they waffled a little bit in terms of their position of default being Democrats don't shut down the government. I mean, that is a long-held foundational belief that, Democrats are the pro-governance and pro-government party, right? They will tell you that. They will pride themselves on that. And as a result, they don't often have the same leverage in some of these instances because if they have to share the blame on shutting down the government, they don't often do it. And so they provided the 7 or 8 votes needed to get that bill over the finish line. But the political realities of that were such that Leader Schumer took a hard dose of criticism from the party base and from House Democrats for not, being more firm in terms of putting forward some opposition. Democratic argument would be that Republicans control all of Washington. They can find a way to keep the government open if they want to do it in a way that results in further cuts or further furloughs or further workforce reductions or whatever it may be, because the difference between now and previous years when the two parties come together on a spending deal is that there's the belief that the executive branch will actually spend the money. But what we're seeing now is the executive branch is not spending the money that Congress has directed them to spend. Instead, they're sending back rescissions packages that want to make further cuts, or they're simply terminating programs and not rehiring the program officers that would then distribute those funds, or they're making executive decisions to close departments, even though there are, legally dubious questions around whether or not they have the authorities to do so. And all of this is playing out in the courts as well. So there's a very bad taste in terms of bipartisanship among the Democrats. And I think that there's a significant dose of pessimism among the Republicans because they have their own internal problems with, juggling the needs of their moderates in order to get reelected, but the desires and aspirations of their, farther right wing who would like to see even more cuts than where they are now. So September is going to be that entire month. We also have the NDAA out there, the National Defense Authorization Act. This is the one other guaranteed vehicle for the rest of the year. And as Peter knows, it often sometimes carries other pieces of legislation. We should expect every member in Congress who has a backlog of priorities that has been sitting on the shelf for the last 7 months to be looking at the NDAA as a potential vehicle to carry their priority. The problem here is that, similarly, these same factions in Congress often decry the use of these larger bills to end up looking like Christmas trees, and that is an official congressional term often used, thrown out there, that you don't want these vehicles that often show up at the end of the year, right before the holidays, to turn into a Christmas tree and carry all of the different ornaments that Congress just didn't get to. And so it creates new divisions within the Republican conference and the Democratic caucus as to how that should proceed. Ultimately, it'll boil down to how much Congress wants to do some horse trading or whether they want to keep it clean. But seeing as it is one of the only other vehicles out there, we should expect that all members set their sights on there as a possible vehicle to carry their bills. Trigger leads last year, Peter, was the one I was referencing. And it very well could find its way back if these two versions aren't rectified that passed the House and Senate before then. They could look to rectify it just right alongside the NDAA.
All right. So thank you for walking us through that. Last question, last topic. We always talk about CFPB, but I think the big one that we have to talk about right now is everything happening over at FHFA. So what is the latest and greatest happening over at FHFA?
So for anyone who follows or who has historically followed FHFA news alerts, you know that in the current administration, the news alerts are often delivered via tweet on X. And Director Pulte has certainly been active on social media. It is clearly his preferred format and medium of communication. Lately, he's been on a bit of a bent, calling for the resignation of the Federal Reserve Chairman Jerome Powell. He normally makes at least one comment a day on that effect. He's obviously trying to tie in Powell's tenure with kind of a static baseline on home ownership and on the general mortgage market. Clearly, it's no secret. It's not a trade secret. Obviously, the president wants Jerome Powell to lower rates. He says it quite often. Director Pulte also wants Powell to lower rates. We all obviously know that Powell himself cannot singularly lower rates, but there are many factors that go into account there. So that's one thing. I think we're all accustomed to where the executive branch is right now in terms of their desire for rates to come down. But Pulte has also made some other recent announcements, some quite interesting. He announced last month that verifiable cryptocurrency holdings can now be counted as eligible borrow assets. He just the other day he announced the allowance of the VantageScore 4.0 as an option in the vein of a one or the other lender choice, whereas the past administration they structured it in a different way that would be kind of a new requirement. This will give the option of either going with the traditional 3 credit reports or your VantageScore. So that was an interesting development. And then he also made an announcement recently, one that has been actually garnered some support from Democrats over the years too. allowing rental history on mortgage applications to be, to help determine your creditworthiness for a mortgage application. He also then was seemingly a little upset about the lack of news coverage on that. And I tend to agree. I was a little surprised that it didn't get more attention in the Capitol Hill news rags and in the housing alerts that we all get. But he continues to amplify that on Twitter, or on X, which he has a pretty sizable following as well. But lastly, I would say conservatorship clearly still on the minds of Pulte. I believe he had a meeting with Secretary Bessent last week about it. Not a lot of details still there about what they're looking to do, but it is clearly something that they plan to make announcements on in the coming months. There's been a heavy dose of focus on it, and we could see some announcements that might be a little, considered a little outside the box as to where they were on conservatorship during the last Trump administration. It didn't really get that far, but some of the more recent comments suggest that they may be taking more of a novel approach on this. So time will tell, but we do expect developments on that in the fall.
All right. Well, as always, I mean, there's never a shortage of things for us to talk about. And I'm sure we could keep talking about several of these things and dive in a lot more. But, we're at time. So, Zach, thank you very much for taking time out of your busy schedule to sit down with us and have this quick little conversation. Always enjoy learning as much as I possibly can from you. But gotta let you go. So, Zach, thank you very much.
All right. Thanks, Peter. Always a pleasure.
And to quickly close out, thank you again to Loan Vision for sponsoring today's episode. And to all of you, we know your time is valuable. Thank you for tuning in to the latest episode of ACUMA's ONpoint Podcast. We hope you enjoyed it. Until next time, be well, my friends.
Thanks for listening. We'll see you next time at the ACUMA ONpoint Podcast. If not already, be sure to subscribe and give us a 5-star rating. For more great episodes and information, be sure to visit us online at acuma.org. And to get the latest updates, head over to our LinkedIn page.